This is a summary of the Auditor-General's report on the Queensland State Government financial statements for 2014-15. In our report, we summarise the results of our audit of the consolidated financial statements of the State of Queensland. The statements report on the results of the general government sector and the total state sector. The financial statements are a consolidated report on the performance and position of the state. The statements also provide a comparison between actual results and the original budget published in Parliament. The statements give us insights into the operation of government. They show how government has obtained its revenues and how they use these revenues to fund day-to-day operations, to replace, renew and add to asset base, and to pay debt. Over time, the financial statements also give us insights into the financial sustainability of the state. We issued an unqualified audit opinion on the financial statements for this year. This means we assess them as representing a true and fair view of the operations and financial position of the state. The financial statements were prepared within the statutory timeframe, although 13 days later than last year. This year, our audit focused on the following transactions. In its 2015-16 budget, the government announced plans to transfer debt from GGS to energy corporations. To achieve this, additional dividends were received in two ways. Firstly, $1.3 billion was received from Energex, Ergon Energy and Powerlink as dividends paid from current year profits. The percentage of profit paid as dividends was increased from 80% to 100% this year. Secondly, $3.1 billion was drawn from the accumulated surpluses and asset revaluation reserves of the entities and funded by borrowings. This additional dividend was reported as a capital return by the state, as it reduces the value of its investment in these entities. The effect of the additional dividends is to move borrowings from the GGS to PNFCs. It will not, however, affect the TSS overall. It will not reduce total state borrowings, nor will it reduce total state interest expense. Accounting for regulated revenue at Energex, Ergon Energy and Powerlink also changed this year. This resulted in a write-off of $1.5 billion to TSS accumulated surplus. This year, the Department of Transport and Main Roads changed the way it calculates the value of its road assets and correctly adjusted assets by $2.5 billion and depreciation expense by $1 billion. Net operating balance is a key measure of financial performance for the state. It shows the revenue earned and the expenses incurred on day-to-day operations. For GGS, the net operating balance was positive for the second year in a row. Both revenue and expenses increased by 6.5%. The TSS continued to record an operating loss, as it has done for the past 8 years. The state is collecting more in taxes, receiving more in Australian government grants, and spending more on employees. The GGS operating revenue increased by $3.06 billion this year. The Australian government increased Queensland's allocation of goods and services tax, and the state earned 6.2% more than last year from taxation. GGS also earned more from the increased dividends from electricity entities. This year, the state increased its workforce by 7,300 employees after a period of reduction in employee numbers. This means that the number of people employed by the state grew by 3.7%. This exceeds the average growth of 0.5% in Queensland's labour force. In 2014-15, the net worth of the state was $168 billion for GGS and $162 billion for TSS. The assets of the state have been added to through acquisitions and capital works and have increased in value. The most significant change in liabilities over the last 5 years has been an increase in the borrowings for GGS and TSS. The state budget for 2015-16 includes an action plan to reduce GGS debt over the next 5 years by $9.5 billion. This includes 4 key actions. moving $3.5 billion of debt from the GGS to the Energy Network Public Corporations. This action will not decrease the borrowings for TSS, nor will it reduce the whole of government interest expense. The government will increase the portion of profit paid as dividends by the energy networks from 80 to 100%. This is an increase of $600 million in revenue for GGS over the next 5 years, and this action will improve the operating performance of GGS. The government will stop contributions of $2 billion over the next 5 years to the investments put aside to fund defined benefit superannuation liabilities. This action will reduce GGS and TSS borrowings. The state will no longer put money aside to pay for future long service leave costs for state employees. The $3.4 billion in current investments will reduce GGS borrowings next year, and long service payments will be funded by debt in the future. This will deliver an initial reduction in debt, but it moves the need to take out more debt into the future for GGS and TSS. The state's financial sustainability has mostly improved over the last 2 years, and government projections included in the state budget for next year indicate a consolidation of this improvement over the next 4 years. We assess sustainability in 4 key areas: operating ratio, which is whether the state meets recurrent costs from revenue; a ratio of operating cash flows to purchases of non-financial assets; looking at the replacement of assets; and gross debt to revenue. This year, the operating sustainability of the GGS improved. Day-to-day revenue and expenses for the state have both increased. The ability of the state to grow revenue continues to depend on economic factors that influence the amount of taxation and royalties earned, and on the state's share of the goods and services tax from the Australian government. Current expenses show the state has returned to increased spending patterns. Employee costs, together with supplies and services, are the largest expense for the state. These expenses increased by 7% this year, after stabilising last year. The increase was included in the 2014-15 state budget, and is faster than this year's inflation of 1.5% and gross state product growth of 0.5%. Queensland's gross debt continues to be higher than every other state in Australia, and the ability of the state to repay gross debt from revenue earned has not improved this year. The state budget for 2015-16 includes an action plan to reduce GGS debt over the next 5 years by $9.5 billion. The state continues to replenish its assets at least the rate of depreciation, indicating that the overall asset base is expanding. The state is funding more of its capital program from operating cash flows. By comparing actual performance to budget, we can assess the robustness of the budget process and the accuracy of predictive models. The actual performance for the GGS has been generally reflective of the budget for the past 5 years, with the exception of estimates for grants revenue. Budgeting for these grants is challenging, as it is difficult to predict the extent of natural disasters and the scheduling of recovery works in advance, along with the timing of grants receipts from the Australian Government. The state faces challenges in preparing budgets for its balance sheet, as the assumptions it uses to value assets and liabilities are beyond its control. Other factors, such as construction costs, sources of funding, and timing of capital works, have also affected the reliability of the budget. Thank you.